Welcome back to The Explainer. Today, we are diving into one of the most heavily debated stories in the entire tech world right now. We're talking about Intel's Q1 2026 earnings. Now, right off the bat, I want to explicitly state that this is my own independent, data-driven analysis. It's built directly from Intel's SEC filings, their earnings call transcripts, and various analyst notes. So to be super clear, this is for informational and educational purposes only. It is absolutely not financial advice, and I am definitely not here to tell you to buy, sell, or hold any stock. My goal? It's just to show you what the data actually says. Strip away all the noise and look at the hard numbers together. Let's get right into it. So, to really understand why this specific quarter matters so much, we have to start with the absolute shockwave it sent through the market. Following the release of these results on April 23, 2026, Intel stock surged roughly 24% in a single day of trading. I mean, just let that sink in for a second. For a mega-cap tech company, a move like that is literally off the charts. In fact, this marked Intel's best single-day stock performance since 1987. The market completely reevaluated the entire trajectory of the company in a matter of hours. So the obvious question we have to ask ourselves is, what exactly triggered this historic rally? Well, let's look at the data to see how a massive earnings surprise basically fueled this entire reaction. Wall Street's consensus estimates were sitting incredibly low at roughly $12.42 billion for revenue. But Intel, they actually delivered $13.58 billion. That's a solid beat of over $1 billion. But honestly, the adjusted earnings per share is where things get really wild. Wall Street was expecting essentially a break-even quarter, predicting just 1 single cent per share. Intel reported 29 cents per share. Guys, that is a staggering 2,800% earnings surprise. Plus, non-GAAP gross margin came in at 41%, which beat the consensus estimate of 39%. CFO David Zinsner actually made it very clear on the earnings call that pushing for gross margin expansion is his absolute top priority, and this print showed tangible, undeniable proof of that effort.
Part 1. Core drivers and disappointments. Because as we all know, headline numbers rarely tell the whole story.
When we peel back the layers, there's a really stark contrast between two of Intel's most important divisions. The Client Computing Group, which represents their traditional PC chip business, generated $7.7 billion in revenue. But get this, that represents just 1% year-over-year growth. The PC market is essentially flat right now. But then you look at the Data Center and AI Group, or DCAI, and that surged 22% year-over-year to $5.1 billion. This is an absolutely critical validation point for the bulls. They're arguing that Intel is finally capturing real upside from the global AI infrastructure build-out, rather than just bleeding ground to its competitors. However, we can't ignore that this turnaround has some severe internal friction. Intel Foundry is supposed to be the cornerstone of their future strategy, right? Well, in Q1, the Foundry brought in a very strong $5.4 billion in top-line revenue, which is up 16%. But the cost to achieve that was just immense. The Foundry segment posted a painful $2.4 billion operating loss for the quarter. Ouch. And compounding that massive hit to the balance sheet, Intel recognized a $3.9 billion non-cash goodwill impairment charge, which is essentially them writing down the lost value of their Mobileye subsidiary. It's a stark contrast, strong top-line growth colliding with the brutal multi-billion-dollar realities of funding a turnaround. Moving on to Part 2, Beyond the Earnings Beat. Because even with that incredible EPS surprise, a financial beat alone doesn't entirely justify a 24% stock pop for a company that's still bleeding billions on the manufacturing side. A lot of this comes down to leadership and the overall narrative. CEO Lip Bhutan took the helm and is firmly framing 2026 as Intel's year of execution. He explicitly outlined that the next wave of AI will bring intelligence closer to the end user, which significantly increases the need for Intel's CPUs, wafer, and advanced packaging offerings. The market listened to this call, and they heard a leadership team that believes they finally have a rock-solid roadmap in place. And strategic hyperscaler partnerships are actively backing up that narrative. Right alongside the earnings print, we learned about a massive, multi-year collaboration with Google to deploy Xeon processors across Google's workload-optimized instances, along with the co-development of custom ASIC IPUs. On top of all that, Intel joined the high-profile Terafab project, rubbing shoulders with SpaceX, xAI, and Tesla. According to several market analysts, these project announcements served a very specific, vital purpose. They helped erase the market's absolute worst fears. Heading into this quarter, there was genuine, palpable anxiety about a potential cash crunch, or maybe even bankruptcy. Landing these massive multi-year volume commitments effectively priced that fear right out of the stock. Which brings us to part 3, skeptics and bear risks. Because we definitely can't stop the analysis here. There is a very vocal other side to this coin, and many analysts completely disagree with the bullish market reaction. To anchor the bear case, we can look at discounted cash flow, or DCF, valuation models from critics. Morningstar, for instance, bluntly called Intel an overpriced stock and a no-moat company. Based on their models, they estimated a fair value of just $32, arguing the stock was trading roughly 33% above its intrinsic worth. Similarly, independent analysis from Simply Wall Street pointed to Intel's trailing 12-month net losses and suggested the stock was trading at a massive premium, based purely on AI optimism rather than actual hard profitability. It's super important to remember these are their specific models and viewpoints, but they represent a very significant skeptical contingent in the market. And honestly, when you dig into the SEC filings, the bears have some very real headwinds to point to. First, Intel just spent $14.2 billion in cash to buy out Apollo's 49% stake in the Fab 34 joint venture over in Ireland. To fund this, they had to take on a brand new $6.5 billion debt load. Second, CFO David Zinsner explicitly warned that rising memory input costs are going to be a margin headwind in the second half of 2026. Third, management is actively forecasting a low double-digit decline in the overall PC market for the year. And finally, critics are quick to point out insider selling. For example, SEC Form 4 filings showed Intel's executive vice president and chief legal officer selling over 40,000 shares on the open market shortly after the earnings release as part of a planned separation. But the absolute most crucial point for the bears comes down to a single number, $174 million. I mentioned earlier that Intel Foundry brought in $5.4 billion in top-line revenue, right? Well, out of that massive $5.4 billion, only $174 million actually came from external third-party customers. The rest was all internal revenue. It's basically Intel paying itself to build its own chips. For skeptical analysts like Bank of America's Vivek Arya, who reiterated an underperform rating, this is the ultimate red flag. Until Intel can prove it can actually land and scale external wafer customers, the Foundry segment remains a massive, highly capital-intensive risk. Let's move on to part 4, key indicators to watch. The data presents a wild picture of a company pulling off a massive earnings surprise while simultaneously navigating existential structural challenges. So let's take a purely observational look at the roadmap for Q2 and beyond. Step 1 is the Intel 18A node. Management says it's early in its ramp, but consistent yield improvements here are absolutely non-negotiable for their margin goals. Step 2 is the big one, securing major external foundry commitments. We absolutely need to see that $174 million external revenue number grow significantly to prove this entire foundry model even works. And step 3 is navigating the back half of the year. With a forecasted decline in the PC market and rising memory costs, the question is, can the explosive 22% growth in data center and AI actually offset the traditional client computing drag? That 24% single-day stock surge really suggests the market believes the absolute worst, the fear of a cash crunch and a failing roadmap, is finally in the rearview mirror. But those multi-billion-dollar foundry losses and the massive debt taken on for the Ireland fab buyout, they tell a story of a company still deeply entrenched in the very expensive trenches of reinvention. Based on the data, the execution phase is now fully underway. So I'll leave you with this one thought to ponder. For Intel's historic turnaround, is the hardest part over, or is it actually just beginning? Thank you so much for joining me for this explainer. As a final reminder, this has been an educational look at the numbers, strictly based on independent research of SEC filings and earnings materials. It is not a recommendation to buy or sell Intel stock. Keep learning, trust the data, and I'll see you in the next explainer.